Hello everyone and welcome to our another exciting lecture series on financial accounting, and I am your instructor Jamal Haider. Today we are starting a new chapter which is called inventory and cost of goods sold. So basically we are finishing the fourth part of our balance sheet. First we covered cash and cash equivalents, then we covered about short-term investments, then we covered about the account receivables, and now we will cover about inventory, and also we'll talk about the cost of goods sold, which is a part of income statement. Okay, so our first learning objective is show how to account for inventory. So let's talk about that. Okay, we begin by showing how the financial statements of merchandise such as Family Dollar Stores Incorporation or the Gap Incorporation differs from the service entities such as FedEx, or in our case here Century 21 Real Estate. So this exhibit 6.1 highlights how service entities differ from merchandises. So did you see something strange here? It's the format. You see, in service industry, your sales are called revenue sale, service sales or service revenue, and then you less expenses. And what kind of expenses you have? You have salary expense, depreciation, income taxes, and you have net income. Fairly simple. But when you talk about merchandise, then you need to segregate sales from cost of goods sold, and then we have gross profit. From gross profit you less operating expenses. What kind of operating expenses? We have salary expense, depreciation, income taxes, and then we're going to have our net income. So did you notice here we have two kinds of profit measures. One is gross profit and one is net income or net loss. Okay, so merchandiser have two accounts that service entity do not have. What kind of? Number one is cost of goods sold on inventory, and number second is inventory on the balance sheet. And why is that? Because there is no concept of physical product in service industry, while in merchandise there is a concept of physical product. So let's move further. So you can see the balance sheet of service industry and of merchandise as well. So in 21st century real estate balance sheet would be, you see here there is no inventory, but if you see the merchandise industry, or the company name is Family Dollar Store Incorporation, you see inventory. Okay, here the exhibit 6.2, it shows the inventory and cost of goods sold when inventory cost is constant. So let's talk about that. So the basic concept of accounting for merchandise inventory can be illustrated with this example. So assume Family Dollar Store has in stock 300 towels that cost 3 each, right? So how are we going to show that? 3 each, 100 towels, and it is written in the current assets as 300, right? So Family Dollar mark each towel by 2 and sells 200 of the towels for 5 each. So it means the family store earning $2 on each towel. In that case, our sales will be, we are selling 200 with 5 each, 1000. And what is the cost of goods sold? The cost of good that you sold. So you sold 200, right? So you sold here 200. So cost of 200 is 3. So that's why 200 multiplied by 3 is 600. So that 400 is called gross profit. Remember, this is not net profit. Why? Because In order to get net profit among the gross profit, you need to less the expenses that you have incurred in order to generate the sales. So you did not incur the sales just by purchasing the towel. You have to pay electricity bills, you have to pay salaries, right, etc. So all those expenses you need to less after the gross profit. So that's why there is a difference between gross profit and net profit. Let's go further. And now moving towards our first learning objective, which is show how to account for inventory. So here is the basic concept of how we distinguish inventory, which is the assets, from the cost of goods sold. Right? The cost of goods sold shift from assets to expense when the seller delivers the good to the buyer. Right? So we have purchased inventory, we write it in our asset, but when we sold that inventory is less. So remember, this is the on-hand inventory, so which you did not sell. So the inventory that you did not sell, that will go to the balance sheet. So inventory that itself will less from balance sheet, and the cost become expense. So the cost of sold inventory become expense. We call that cost of goods sold, and that would be an expense right after the sales, and it would be written on income statement. So note the differences between the sale price of the inventory and the cost of the inventory, right? So sale price is recorded in the sales revenue, cost price is recorded as cost of goods sold. Fairly simple. How we can find out cost of goods sold? Cost of goods sold is number of units sold multiplied by the cost per unit of that inventory. Whereas the inventory is number of units inventory on hand. So these are those units that are not sold, that are still in our possession. So which one is in our possession? That is asset, right? So that's why it is treated as asset, and its life is less than 1 year. So normally it is sold less than 1 year. So we call this current assets. And it's number of units on hand multiplied by the cost of per unit, right? Fairly simple. So how we're gonna measure the number of units of inventory on hand? So it will be determined from the accounting records. It is evidenced by physical count at the end of the year. You give tasks to the internal audit department, and they physically, you ask the watchman and all the stuff. You match the receipts of material going out, or inventory going out from the store, and etc. There are some kind of check and balance over there. You go and physically count. You can also find out the inventory on hand. Now the real question arises, and that is consignment goods. So companies do not include inventory any goods that they hold on consignment because the goods belong to another company, right? And but they do include their own inventory that is out on consignment and held for sales by another company, right? But there is a difference between in-transit goods, and that depends on shipping term. There are two shipping terms that we discussed in our previous lecture, that is FOB shipping and FOB destination point, right? So if FOB is on shipping, right, it means freight on board and on shipping point. It means the goods belong to the customer as soon as order is placed and goods leave the factory. In that case, you deduct these number of units from your inventory right after they leave the factory premises to the shipping point. For example, on freight, sorry, on the board or some other part where the customer will take or pick their goods. Destination point, you less these number of units sold from the inventory when the goods is being delivered, right? So until then, that will be the part of your inventory, and that is your asset, right? And now, more thing that we can explain here, the same concept. So it is FOB on freight. It means at the point when goods leave the seller's shipping dock, and FOB on board or destination, which is at the point of delivery to the customer specific destination. So company with legal title to the goods while in transit pays the transportation costs, right? So if it is on delivery to the customer door, then transportation cost will be borne by the company. If it is shipping cost, then transportation costs up to the shipping dock is paid by company, and after that it is customer responsibility. Okay, now let's talk about the inventory accounting system. So there are two main inventory accounting system. One is called periodic and one is perpetual. So the periodic accounting system is used for inexpensive goods. For example, a fabric store or a hardware store won't keep a running record of every bolt of fabric or every 10 penny nail. So instead, these counts, their inventory periodically, at least once a year, or at the end of the day, to determine the quantities on hand, right? So business such as, the other example include restaurants, hometown, nurseries. So they also use this periodic system because the cost of this system is a little bit low. Why? Because at the end of the day, or at least once a year, you just, open your books. Okay, you bought this goods, and at the end of the day or at the end of the year, you sold this much, good, and that's it. So while the perpetual inventory system uses a computer software, and it can be used for all type of goods. So the perpetual inventory system, it achieves control over good, such as, you can say you are selling furniture, automobile, jewelry, apparel, and most of, this or other types of inventory. So most business, they are using perpetual inventory system. So even with perpetual inventory system, the business still counts the inventory at least once a year, and the physical count establishes the correct amount of ending inventory for the financial statement and also serve as a check on the perpetual records. So the summary include is that they do keep a running balance, a running record of all goods bought and sold on hand, right? So if you go to the drugstore, you buy some kind of drug, they enter it into the system, and from the system it is less from the inventory, right? So it means constantly they are upgrading their computer systems, right? Or if you go to buy some kind of like furniture, or if you go to the IKEA store, right? They scan the barcode, and automatically it is deducted from their inventory, and by looking at the screen they can, they can tell you that like the balance of this item is, for example, is 10 units or 100 units it has left, and it's time to reorder, or or maybe they have enough amount of that kind of unit. So in perpetual inventory system, a software is needed because we are selling and we are upgrading at the same time, while in periodic system you check the inventory on periodic basis, right? After the closure of the business, or at the end of the weekend, or at the end of the month, or at the end of the at least once a year, right?